Most traders think that the only way you can get funding is through prop firms. And although prop firms are the easiest and are the best place to start, they're not the end game. The real wealth, the life-changing capital, often comes from private investment. This is from millionaires who aren't looking for you to jump through hoops on a demo account. They're looking for traders that they can trust, that have skill, that have patience, that have a real edge. And they're looking to build a long-term relationship. In this video, I'm going to break down a 3-step process that I've used and continue to use to attract millionaire investors. Now, I want you to comment below your biggest trading psychology challenge. I want to offer you an insight. My 3-step process, RNR, is simple. Any trader can follow it. The first step is record, track record. The next is network. And the final of the 3 is risk. If you follow this 3-step process, which I'm going to break down for you step by step, you're going to put yourself in a position to be able to attract millions of dollars worth of private investment to leverage your skill as a trader. Now, the first step in this 3-step process is track record. Every trader, before they go off and seek private investment, must have a mechanical edge, meaning they have a proven trading edge, a proven trading strategy, knowing where to enter into the market and where to exit out the market. They also have proper risk management. Now, within that risk management, they're risking a maximum of 1% of the total account size. They've also got a drawdown buffer in place so that the deeper they go into drawdown, they reduce their risk, a drawdown risk protocol. Finally, every trader should have a max daily loss, how many losses they're willing to take. For example, maybe it's 2 losses, 2% on the day. And then every trader should have a max drawdown, how much they're really willing for their account to go into drawdown before they cut it. And usually anywhere from 10 to 20% is a great max drawdown. All these risk rules become very, very important when you're pitching to private investors. Now, you want to prove your entry and exit model. You want to make sure it truly has an edge, has a sample space so that you're clear on your strike rate and you're also clear on your win and loss rate. And you can see that at the end of a larger sample space, 100, 1,000 trades, you will both win and lose, but at the end of that larger sample space, you will win more than what you lose, giving you your edge, your net profit. You want to take that edge and you want to put it into a mechanical trading plan. Why? Because really what your investors are buying into is your ability to consistently execute your edge. And you want to show them that you have, yes, an edge, but you've also put it into a system that allows you to consistently come to the market and execute it. And that's really the first step. You want to backtest this and have data to prove that edge. And that will be important when you go and pitch your private investment. Next, you want to have a process to be able to stick to your edge. And this will be very important when you're pitching to your investors. You want to show them that you have a particular tool or a process or something in place to be able to manage yourself so that you can stick to your mechanical edge. Because they're going to be thinking, what happens if you're not feeling great that day? What and how are you going to make decisions in that moment? So for example, you want to download my Bulletproof Your Trading Mindset tool, free link in the description. And you want to start to use that as a way to help you stick to your mechanical edge. And you'll be able to show your investors that you have a proven methodology, a tool that you follow step by step so that you can stick to your mechanical edge. And then your focus as a trader goes to sticking to your mechanical edge with the mindset tools and showing to yourself, firstly, that you can stick to your mechanical edge. Then what you want to do is move on to this third part, which is about proving your profitability. And the way you prove your profitability, the best way to do it and the cheapest way to do it is through prop firms. So you want to start with your first 100K challenge, for example, and you want to pass that prop firm challenge by sticking to your mechanical edge, using the Bulletproof Your Trading Mindset tool before every trade, reviewing your trading plan and sticking to your trading plan. And what you're doing is you're building data and you're building evidence to then take forward to your investor to show them that you have a proven system that you can stick to that actually works, that yields profitability. And what I would suggest to every single trader is they utilize prop firms as a way to prove that. If you can't pass prop firms and you can't be profitable in prop firms, then there's no point going for private investment. Private investment has a lot more risks, it takes a lot more work, and there are benefits and drawbacks both ways, but the prop firms are easier to set up. There's no risk on your shoulders except what you pay for the evaluation fee. So you want to utilize that and leverage that and take advantage of that, and that's the way you prove your profitability. But then private investment has the ability to scale beyond what prop firms can offer, and it also allows you to have a long-term sustainable relationship with an investor that you can do this year in or decade in, decade out, and you can have a longer-term vision with them. So my suggestion, if I was to be asked prop firms or private investment, both. Start with prop firms, utilize them, then move in to private investment once you have a proven profitable edge that you know you can stick to because you've passed prop firms. And really what I think would look really good to a private investor is having $300,000 accounts, real accounts, you pass the evaluation on them, and then you can show that for 6 months you've consistently stuck to your mechanical edge on those three $100,000 accounts. And if you can do that, you can take that to a private investor and show that you have a drawdown to reward ratio or reward to drawdown ratio of 25-10, meaning that you have three $100,000 prop firm accounts. And for 6 months, you've stuck to your mechanical edge on those three $100,000 accounts. And you've returned within this ratio. Now, this return to drawdown ratio is industry standard and it's per annum. So if you have a 6-month track record, you need to do half of this. You don't want to be going down below 10% drawdown, okay? You need to prove to your investor that you won't ever go below 10% drawdown. And the way you do that is by having your drawdown ratio reduce your risk. The deeper you go into drawdown, the more you reduce your risk. So you never hit more than max drawdown of 10%. You want to show to your investors that you can, within 6 months, hit 12.5% in 6 months without going below 10% in drawdown. If you can do that on three $100,000 prop firms accounts, that's a great goal to aim for, and that's a great set of evidence that you can then take to an investor to start that process of looking to build an investment relationship with them. Now, where do you find these investors? How do you start resonating on the level where you can start have lunches and dinners with these private investors? Well, firstly, you want to start surrounding yourself with where these investors are, okay? A lot of them have a high value on health. They're later in life, they start to prioritize their health. So wellness clubs and higher level, more affluent gyms in affluent areas are great places to go, especially if there's a social aspect to that gym. Wellness clubs are a great place to be. And you can start surrounding yourself with these individuals that are playing on that level. Now, if you're an individual with a lower class mentality and you don't feel worthy of having interactions with these individuals, that's going to reflect in your language, that's going to reflect in your body language. They're going to read that, they're going to know that you perceive yourself below them, and they're going to feel like they're getting a worse deal talking to you, so they're going to talk to you. So you also need to climb up the psychological ladder of where you feel worthy to play at. And really the way you do that, firstly, is by doing the first step I covered. Proving to yourself that you can pass these prop firm accounts and you can consistently get a great result and a great return on those prop firm accounts at scale. You're proving to yourself you're the asset. And the truth is that skill that you've developed is a lot more difficult than getting access to money. So when you prove that to yourself, you realize you're the asset, and your certainty and your confidence within yourself goes through the roof, and you feel like you're able to offer something to these individuals. And as a result, when you feel like you can offer something valuable to these individuals where you can help them multiply their money far beyond a lot of the conventional investments out there, you then all of a sudden feel worthy of resonating on those levels as these individuals, and you feel like you can offer something to them. So you're going to be going into that conversation with a lot more certainty and confidence. And do you just go up to them on the first interaction and tell them about your trading and tell them what you can offer them? No, you start to build a relationship with them. You start to have a bit of a joke and a bit of a laugh with them, and you start to learn more about them and be genuinely interested in them, because they probably have a lot of experience in business and in finance that will probably help you as well. So you want to be genuinely interested in them. And then eventually the conversation might turn to the idea of investment later down the track. But this is a long-term game. This is where you start to build relationships. And maybe one day there's an investment that's exchanged and you're able to get funding from this individual. But you don't want to go into it with that mentality. You want to go into it with the mentality that you're genuinely interested in this individual and you want to build a relationship with them. It's just like when you're dating. At the start, you take it slow, you chat a little bit, you wine and dine, all that type of stuff. And then eventually things become more and more serious later in the relationship. And if you just went straight to the serious stuff on day one, it's a little bit of a turn off to both parties because it creates a sense of desperation. Whereas if you know you're the asset and you've got your options of the prop firms right now, you're not desperate. You focus on a long-term relationship that eventually you think can turn into something that's an investment. But you're not desperate for that right now, because right now you're leveraging prop firms. And you got your prop firms, you get your payouts from that, you can build your personal accounts, you can take on more and more funding through different prop firms, and you can scale that. And all the while you're starting to build your networks and relationships for private investment later down the road. And then finally, we talk about the final step of this process, which is all about risk, mitigating risk. And really, after you have that proven track record for about 6 months, let's say, for example, you go in there and you've spoken to your accountant and your lawyer and you've got the proper structuring and all that type of stuff. You've got everything you need to get to structure it properly. It's all done legally. You then are looking to take on $1 million worth of investment. Don't start with $1 million go into a little bit of a probation period. And for the first 3 to 6 months, take on smaller portions of that capital and perform on that capital. Prove to the investor that you can perform on that. Prove to yourself you can perform on that. And then slowly add more and more capital. So don't just go into it cold turkey on that private investment. Start with the probation period and slowly scale it up. Ensure you've got your proper risk rules in place. Do not risk more than 1% on each individual trade. Ensure you have a drawdown protocol, and ensure you set a max drawdown buffer and a max drawdown that you can hit. And if you hit that max drawdown, let's say for example it's -10 or -20 with a private investment, communicate to the investor in the contracts, with the legal contracts, the accountant and the lawyers, that we're going to have a max drawdown on this account of -20. So you can't lose more than 20% of the investor's account. So that's the max drawdown, -20 for example. Maybe make it -10. It's completely up to you, but giving yourself a little bit more leeway is often better for the psychology. But you've also got the drawdown protocol in place so that with the 1% risk rule, you minimize your risk the closer you get to the max drawdown. When you get 5% into drawdown, you don't want to be continue to risk 1%. You want to reduce your risk, half your risk, to 0.5. And what this does is it helps you protect your psychology so you don't introduce fear and greed into the trading. You don't go deviating from the plan, revenge trading, all that type of stuff. And then finally, you want to be managing expectations. You want to be bringing all the worst case scenarios up front, and you'll be showing what you've done to mitigate those and putting contingencies in place to manage all worst case scenarios. And let's say, for example, they're going to give you $1 million worth of investment with a max drawdown of -20%. You're communicating expectations that what they could potentially lose is -200,000. And although you have every duty and responsibility to make sure that doesn't happen, and you show what drawdown protocols and what risk rules you have in place, that's the expectation you're communicating to them. And you're also communicating realistic returns in what you communicate. You don't communicate crazy returns. Communicate the returns of 25% per year with a max drawdown of -10. That meets the ratio. And if you communicate realistically, they're not going to be disappointed. So consider private investment as a long-term play, but right now leverage prop firms. Take advantage of them, okay? Now, before you click away, make sure you watch this psychology video that's going to pop up on your screen. I'm going to show you how you can bulletproof your trading psychology so you can stick to your trading plan and you can have consistent profitability. You can scale it with prop firms and you can eventually start building private investment.